What really happens when a major futures exchange suddenly goes dark right before delivery day? Trading stops. Orders are canceled. The benchmark price disappears for a while. And then, just like that, the market reopens. For most people, it looks technical. For serious gold and silver investors, it raises a much bigger question. Is this just routine volatility, or is something deeper shifting inside the system? Welcome to Gold-Silver Scope. When a benchmark futures market halts trading for 90 minutes and cancels same-day orders just ahead of first notice day, the mechanical effect is obvious. Liquidity becomes thinner. Spreads can widen. Price discovery slows down. When fewer participants can transact in the main reference market, short-term uncertainty increases. That part is simple market structure. If one major highway closes, traffic gets tighter on the remaining roads. But here is the key point many investors miss. The physical gold and silver market does not stop. Dealers continue to sell. Wholesalers continue to move metal. Private transactions continue globally. A futures halt does not erase demand for physical metal. It only disrupts the paper pricing mechanism temporarily. So the real question is not what happens mechanically. The real question is, why does it happen at that specific moment? Is it just increased volume putting pressure on exchange systems? Is it coincidence, or is it stress inside the system that requires time to rebalance? We cannot speculate without evidence, but we can observe patterns. When trading halts cluster around delivery periods, investors naturally become more alert. Delivery day matters because it is when paper contracts can convert into real metal. That is the bridge between financial promises and physical supply. Any disruption near that moment draws attention. Now step back from the short-term noise and look at the larger trend. Regardless of temporary halts, gold and silver have been in a long structural bull market. Gold was under $300 decades ago. Silver was under $5. The move we have seen over 25 years is not random. It reflects currency debasement, expanding debt, monetary easing cycles, and declining trust in fiat systems. Some people argue, this bull market has been running for 25 years, so it cannot be early. But markets have phases. The first phase was driven by monetary expansion and early adopters. The second phase involved institutional awareness. What we are entering now is different. The early stage today is not about price history. It is about participation. Central banks have become aggressive net buyers of gold in recent years. That shift is powerful. For decades, many central banks were sellers or passive holders. Now, they are accumulating. That signals something important. Sovereign institutions are diversifying away from pure dollar exposure. When central banks move, they move with long-term intention, not short-term speculation. And this trend is not mature yet. The central banks already buying gold are likely to increase reserves further. Those that have not started meaningful accumulation may begin. Gold for them is not just an investment. It is a strategic reserve asset outside counterparty risk. At the same time, mainstream private investors are still underexposed. Despite gold's long rise, portfolio allocations in many Western markets remain minimal. Many investors have zero exposure to physical metal. That means the crowd has not fully arrived yet. When you combine three forces, central bank accumulation, gradual institutional participation, and future retail awakening, you create structural demand pressure. Short-term volatility does not cancel that equation. Even during periods of excitement, physical retail demand is not always at extreme levels. In past crises, like global health shocks or financial panic years, demand spiked sharply. Compared to those peak panic moments, activity today may look moderate. But that actually supports the early participation thesis. If prices are rising without full retail frenzy, what happens when fear or inflation concerns intensify again? Many investors who ignored gold during years of stock market growth are starting to reconsider diversification. Some were distracted by other high-volatility assets. But cycles rotate. When speculative bubbles deflate, capital looks for stability. Historically, gold benefits during those transitions. Institutional investors may not rush into physical delivery, but they can enter through exchange-traded products, mining equities, and royalty companies. Pension funds, hedge funds, and endowments often move slowly. But once asset allocation committees shift their models, flows can become consistent and powerful. Now add another emerging dimension: the intersection between precious metals and financial technology. For years, digital innovation focused on purely fiat-linked stablecoins or speculative tokens. But tokenization of real assets introduces a new possibility. Gold can be digitized while remaining physically backed. That changes functionality without changing the underlying monetary nature of gold. Gold has always been strong as a store of value. Its historical record compared to fiat currency is clear. Over long periods, fiat currencies lose purchasing power. Gold preserves it. When people understand that difference, especially after living through inflation cycles, their mindset shifts. If digital platforms make gold more divisible, more portable, and easier to transact while still physically backed, its monetary properties become even stronger. Historically, gold's limitations were storage, transport, and transaction friction. Technology reduces those frictions. This is why temporary exchange halts do not change the core thesis. Structural monetary stress, rising sovereign debt, central bank diversification, and growing awareness of currency debasement are long-term drivers. Paper market disruptions may create headlines, but they do not reverse monetary reality. The deeper shift is psychological. Investors are slowly moving from blind trust in fiat systems toward diversified protection. That transition takes time. It rarely moves in a straight line. There will be volatility. There will be pauses. There may even be engineered slowdowns. But trends built on monetary fundamentals tend to outlast short-term disruptions. And if the benchmark pricing system experiences stress during critical moments, it does not weaken the case for gold and silver. For many serious investors, it strengthens it. Now let's go deeper into where the real shift may be happening, and why the next phase of this gold and silver cycle could look very different from the last 25 years. For decades, gold mostly moved because of monetary policy cycles, inflation fears, and currency weakness. It reacted to crises. It responded to central bank easing. But today, we are seeing something more structural forming underneath the surface. Central banks are no longer passive observers. They are active accumulators. When sovereign institutions consistently add gold to their reserves, that sends a long-term signal. They are reducing reliance on paper reserves and increasing exposure to a neutral reserve asset that carries no counterparty risk. That trend is not driven by short-term price charts. It is strategic positioning. And here is the key. Central bank demand is price-insensitive compared to retail demand. A central bank does not buy gold because it is cheap this week. It buys gold because of long-term monetary security. That creates a strong floor underneath the market over time. Now combine that with a second force: institutional money. For years, large institutions largely ignored physical precious metals. They preferred equities, bonds, real estate, and more recently, high-growth digital assets. Gold exposure in many portfolios remained extremely small relative to total assets under management. But institutions move in waves. When volatility increases in traditional markets, when bond yields fluctuate unpredictably, and when equity valuations stretch, asset allocators begin searching for hedges. Gold historically performs well during uncertainty and currency debasement cycles. Institutional money does not always rush directly into physical bullion. It often flows first into exchange-traded products, gold-backed funds, mining companies, and royalty firms. These vehicles provide liquidity and exposure without storage logistics. Once those flows start building, the underlying physical demand strengthens as well. And then there is the third layer, technology and tokenization. For years, the focus in digital finance has been on tokens backed by fiat currencies. Stablecoins pegged to the dollar became dominant. But think about that structure carefully. A dollar-pegged token is still exposed to the purchasing power decline of the dollar itself. It may be stable relative to $1, but that dollar is not stable relative to goods, services, or gold. Now imagine a token backed by physical gold. Instead of tracking a currency that is designed to inflate over time, it tracks a monetary asset with thousands of years of history as a store of value. The difference is structural. From 1913, when modern central banking structures expanded significantly, the purchasing power of the dollar has declined dramatically relative to gold. What once bought an ounce of gold requires vastly more dollars today. That is not an accident. It reflects long-term currency debasement. So if someone must hold a non-interest-bearing digital token, what makes more sense long-term? One pegged to an inflating currency, or one backed by a scarce monetary metal? This is where the psychology begins to shift. For decades, people tolerated inflation because they had no practical alternative for daily transactions. Gold was strong as a store of value, but it was not easy to use in commerce. It required conversion back into fiat to pay bills, salaries, and expenses. Technology reduces that friction. If gold can be held digitally, divided into small units, transferred instantly, and redeemed physically, it begins to compete directly with traditional banking functionality. It becomes more than a hedge. It becomes usable money again. This possibility changes the long-term demand equation. Gold demand no longer depends only on fear. It can depend on convenience and efficiency. Now think about the banking system. When people deposit money into a bank, legally, they become creditors of that bank. The bank uses deposits to generate returns, primarily through lending or purchasing financial assets. Depositors receive limited yield while carrying institutional risk. If individuals can hold tokenized gold that remains their property, not a bank liability, and still transact freely, that shifts the power balance. It reduces dependence on traditional intermediaries. Of course, governments and regulators will not ignore such a shift. Monetary control is a powerful tool. If alternatives to fiat systems expand rapidly, resistance could emerge. That introduces regulatory risk, which investors must always consider. But from a purely economic perspective, the logic is strong. Gold has outperformed fiat currencies over long time horizons in terms of preserving purchasing power. If technology enhances its usability without weakening its scarcity, demand can broaden significantly. And remember, we are not yet seeing full mainstream participation. Retail interest today is steady, but not extreme compared to major crisis years. That means there is room for expansion. Many investors still allocate 0% of their portfolio to physical metals. Many institutions remain underweight. When participation broadens across sovereign buyers, institutional allocators, and retail investors, while new technological channels increase access, the pressure on available supply intensifies. Silver adds another dimension. Unlike gold, silver carries strong industrial demand alongside monetary appeal. Green energy systems, electronics, and manufacturing rely heavily on silver. That dual role can create tighter supply conditions during economic expansions. So when we analyze temporary exchange halts or volatility spikes, we must separate noise from structure. Short-term disruptions can influence spreads and liquidity. But structural monetary shifts, central bank accumulation, technological transformation, and gradual mainstream adoption form the real foundation. The long bull market in gold may have started decades ago. But the next stage, driven by institutional scale, sovereign diversification, and functional digital integration, may still be in its early chapters. Markets rarely move in straight lines. Corrections will happen. Consolidation phases will occur. Skepticism will return at times. But when the monetary foundation beneath fiat systems weakens, while confidence in real assets strengthens, the long-term direction becomes difficult to ignore. And that is where the real story lies, not in a 90-minute halt, but in a multi-decade shift in how value is stored, transferred, and protected. Now let us bring everything together and look at the bigger picture with clear logic and calm analysis. Short-term market halts, canceled orders, or temporary liquidity disruptions can create dramatic headlines. They create fear, speculation, and strong emotions. But serious gold and silver investors must train themselves to look beyond the noise. The real question is never what happened for 90 minutes. The real question is what direction the monetary system is moving over the next 5, 10, or 20 years. Gold and silver are not reacting randomly. They are responding to structural realities. Global debt levels are higher than ever. Governments continue to rely on borrowing. Central banks continue to manage economies through monetary expansion when pressure builds. Currency supply increases over time. Purchasing power slowly erodes. This is not a conspiracy theory. It is basic monetary math. When more currency units are created faster than real productivity grows, each unit loses value over time. It may happen slowly, but it happens consistently. History across centuries confirms this pattern. Gold operates outside that system. It cannot be printed. It cannot be created by policy decision. It must be mined, refined, and physically produced. That supply discipline is why gold preserves purchasing power across generations. Silver shares similar monetary properties, but it also has industrial demand. As technology expands, electronics, solar infrastructure, medical applications, silver demand remains strong beyond investment purposes. This dual demand structure can amplify price moves during tight supply cycles. Now consider investor psychology. For many years, confidence in fiat systems was high. Stock markets delivered strong returns. Bonds provided steady income. Alternative assets like digital tokens attracted speculative capital. During such periods, gold is often ignored because it appears quiet and defensive. But cycles change. When volatility increases, when inflation becomes visible in daily life, when purchasing power declines noticeably, people begin to search for protection. They begin to ask deeper questions about money itself. That is when gold and silver re-enter mainstream conversation. We are currently in a transition phase. Central banks are already accumulating. Institutional investors are gradually increasing exposure. Retail investors are becoming more aware, but full-scale panic demand has not yet arrived. That combination suggests we are not at the end of the cycle. We are in the development stage of a broader monetary shift. Even discussions around tokenized gold and digital settlement systems point towards something bigger. The world is not rejecting technology. It is integrating technology with hard assets. When gold becomes easier to divide, transfer, and settle digitally, its historical strength as money combines with modern convenience. If individuals and businesses can transact using gold-backed digital systems while maintaining direct ownership of real metal, the demand base expands further. It is no longer only about crisis protection. It becomes about monetary efficiency and independence. Of course, no asset moves in a straight line. Corrections are normal, pullbacks are healthy, markets breathe, and regulatory risks always exist when monetary structures evolve. Governments protect their currency systems carefully. But from a long-term analytical perspective, the trend drivers remain intact. Rising sovereign debt, persistent currency expansion, central bank diversification, institutional reallocation, gradual retail awakening, technological integration. When you combine these forces, the long-term direction for precious metals remains structurally supported. The most important lesson for investors is patience. Gold and silver reward long-term discipline more than short-term speculation. They are not lottery tickets. They are monetary insurance and purchasing power protection tools. If exchange disruptions occur again in the future, remember this: temporary paper market stress does not invalidate physical demand. It often highlights it. Delivery periods, liquidity events, and pricing volatility simply remind us that behind every contract is real metal and real scarcity. As always, stay informed, stay rational, and focus on fundamentals rather than headlines. If you value clear and honest analysis about gold and silver, make sure you stay connected with Gold Silver Scope. This channel is dedicated to helping you understand the deeper monetary shifts shaping the precious metals market, so you can think independently and position wisely for the long term. And finally, a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Always do your own research and consider your personal financial situation before making any investment decisions. The gold and silver story is not about one trading halt. It is about the future of money itself.